What's going on, guys? Welcome back. So I'm finally back in front of the whiteboard again, and in this video I'm going to be going over my top 3 stock picks for the month of March. Now, as you guys know, I have, kind of shifted my investment strategy and also my overall investment thesis on the overall market over the past couple of months. And, I'm getting more and more skeptical and more defensive in my investment picks. I generally only focus on either growth companies that I think are trading at a big value or companies that I think are going to be able to return money to shareholders regardless of what's going on in the overall economic climate. And that is exactly what these companies that I'm going to be talking about here in this video I expect to do. So if you guys are interested in that, make sure to stick around, hit that like button, hit the subscribe button, and let's get in the video. So starting off the list is Intel Corporation. Now, you guys know that I've been talking about Intel and I've been bullish on Intel for months now. And Intel, in my opinion, is still one of the best picks in the technology semiconductor space, regardless of what you expect out of the overall economy over the next couple of years, just due to the fact of how monumental this company is and also how well managed this company is. So as we look into it right now, Intel currently stands with a PE of just under 12, and their free cash flow came in at just under $15 billion for 2018. And 2018 was one of the hardest years for Intel and majority of the semiconductor space. For a while now, over the past 5 years, the semiconductor space has just kind of been exploding with revenue growth and also the amount of money that they're generating. And Intel still comfortably maintained about a $14 billion free cash flow. I think that Intel has a pretty good financial situation, and I think that Intel is able to kind of manage whatever happens in the overall climate due to the fact of how high their current free cash flow is, and also the fact that they're not trading for an astronomical overvaluation. Now, just a couple of things to keep in mind when you are looking into Intel or any other semiconductor company, in the overall space, is that they are all cyclical. Now, semiconductors, and I've kind of harped on this a lot here on this channel, is that they generally kind of outperform or underperform whatever the overall economic condition is. If the economy is doing really well and everybody's pumping money into growth, obviously semiconductors are going to be, kind of getting the majority of that inflow because that is how you expand in technology. And then once we hit a recession, a lot of those budgets get cut and these semiconductor companies will get hurt and a lot of their earnings will drop to the floor. So that's just kind of something you need to keep in mind. However, Intel is coming out with their new CPUs. Finally, it's been about 2 years now that they've been kind of prolonging their next generation of CPUs, or their next real generation of CPUs, let's say. And between their modularity that they're introducing with this new set and also the fact that so many people were kind of waiting off in the sidelines to really, go in and upgrade their investment grade CPUs, whenever they're looking at for a large company, all of their servers for all of their warehouses and their data mines. Obviously, they think that all these companies are waiting for Intel to kind of bring out this new CPU lineup, which should be here in the second half of 2019. So I definitely think that Intel, has a light at the end of the tunnel. All else considered, if we have an economic recession, obviously this is going to kind of hurt the company as it will all other companies. But I do think that they have an ability to really take a lot of that revenue that they kind of left on the table last year and then boost up their free cash flow number, say even close to $16 billion, even if they don't expect much revenue growth in this year. And again, I do think that Intel is going to be the best bet in any semiconductor space right now, whether or not the economy does well. Now, you can take a company like AMD or Micron, and if the economy continues to do really well, those companies will drastically outperform Intel. However, neither one of those companies currently pays a dividend. Their debt to equity in AMD's case is not really manageable, and in my opinion, if there is an economic slowdown, a company like AMD is going to get hurt significantly more than a company like Intel. So I think overall net, when you factor in risk and you factor in how these companies are actually going to perform, I think that Intel in the semiconductor space is going to be your best bet for an absolute return over the next couple of years. Now, the next company on my list is Restaurant Brands International, ticker symbol QSR. And this company, for those of you that don't know, is the company that is kind of the new conglomerate that just came out a couple of years ago with 3G Capital and a couple of other major hedge funds and private equity companies. And they essentially own the 3 brands, Burger King, Tim Hortons, and Popeyes. Now, obviously, I don't need to tell you guys that these 3 brands are going to be doing moderately the same regardless of overall economic conditions. None of these companies are, say, the creme de la creme of their individual space, and they're not the, the very premium product. So I personally think that these companies, while experiencing massive growth over the past couple of years, and if you want to check out their last earnings report, they kind of go over how monumental these companies are growing. Burger King is actually the fastest fast food company growing in the world right now. And I don't think that this company is really going to have to deal with much fluctuations in the overall economic environment. And I think that these 3 brands are kind of well known enough that way they will stand the test of time and they will be a place that people continue to go to regardless of what their paycheck is. If people are going out to get a quick bite to eat, or if they want a cup of coffee in the morning, I definitely think that any of these three companies are a very viable option regardless of what the overall economic condition is. Now, taking a quick look at the company right now, their PE sits at about a 26. Now, that is a little bit inflated due to a lot of issues that they just had with their non-GAAP and GAAP basis on their last earnings reports and their couple of balance sheets. However, forward consensus is about 20 to below, so I definitely do not think that this company is screaming high in the PE stance. And also, when you factor in how much growth this company is going through, I don't think that the PE of 26 realistically says that this company is screaming overvalued. You also got to take in consideration that the company is supporting over a 3% dividend yield, which is amazing, especially in the fast food chain of a company that is of this size. So a 3% dividend yield with a price to earnings ratio currently of 26, I definitely don't see any drastic overvaluation right there. And I also think that that dividend is moderately safe when you look at, in comparison to peers that, are pumping a lot of debt into the company just to kind of support everything and pay off that dividend. I definitely think that QSR has a moderate understanding of what's going on, and I really like their management and how their new management has been taking the overall company since the merger just a couple of years ago. And one thing I really want to focus on is that the ROE for this company as a whole is almost 40%. Now, if you look at fast food chains across the board and you look at, say, McDonald's, or if you look at Yum Brands or any individual company's comparison of what their ROE is for those individual investments, I do not see many companies sporting a ROE of about 40% without being significantly over leveraged. QSR's debt to equity ratio is fairly manageable in my opinion, and I definitely think that their free cash flow covers all of their interest expenses, and I definitely don't think that they have any real fear for an economic downturn. I definitely think that this company is going to be able to, kind of stand the test of time. And, supporting these numbers, I definitely think that if you're looking for a play in the fast food chain, you want some growth and you also want a really good yield for your investment, I definitely think that Restaurant Brands International is going to be one of the best picks in this overall environment. And I think it may or may not have a spot for it in your portfolio. You guys let me know in the comment section down below, but I personally am looking at this company very closely and may or may not be starting a position in it. And now my last pick for the month of March is American Eagle. Now, you guys know that I've been talking about American Eagle over the past couple of months now, and I still think that American Eagle is a very interesting play in the retail space, and I think that American Eagle kind of is, deserves to trade at a higher level to its competitors than it currently is. And so I think that there is a big value opportunity with not much downside, in my opinion. Now, if you take a look at their financials, just going down the list right now, you see that their PE is just under 19 when the average in this space is over a 20 to a 22. So I kind of like that. They're trading at somewhat of a discount, but I do think that, how the company is overall performing, I do think that PE would be more justifiable around a 20 to a 25 in comparison to peers. Their dividend yield comes in at just under 3%, being a 2.76%. And their ROE for a retailer, no less, is over a 20%. Now, if you look at a company like, say, Macy's or any of the other, in this niche type of category, say, it's like Abercrombie, Zoomies, things like that, their ROEs are not nearly as robust as American Eagle is, especially if you take out the amount of debt that those companies are tacking on in order to really expand that ROE. So I definitely think that American Eagle is focused on returning a lot of value to their shareholders. Their return on equity is, kind of above the rest when it comes to these type of niche, smaller retail firms. And so I definitely think that American Eagle is executing properly. But the main reason why I think that American Eagle is such an attractive value play is because of Aerie. Now, Aerie is kind of exploding in growth. Aerie has had year after year and quarter after quarter of 20 to 30% growth in any metric that you look at it. And I definitely think that this is kind of showing the shift in consumer trends. A lot of people, especially in the millennial bracket, are switching away from companies like L Brands with Victoria's Secrets, and they're going to American Eagle. And that is, I think, where is going to be the big revenue driver for American Eagle over the next couple of years. And I think that they have only just begun to really eat away at that market share. And if you look at the amount of money that L Brands gets valuated based off of their sales in Victoria's Secrets, say, if you have L Brands that has been trading anywhere from like $7 to $9 billion over the past couple of years, and you want to say if American Eagle is able to take away, say, 20-30% of that overall bracket, say they're going to be taking a couple $1 billion off of Victoria's Secret's revenue. And now you look at the fact that American Eagle is trading at a valuation of under $3 billion, you essentially can almost double the company, assuming Aerie is able to execute as well as it has been in the past, and essentially can take that overall market that is surrounding Victoria's Secrets. So that is the main growth driver as to what I think American Eagle will be outperforming the majority of other retailers retail companies, and it's also noticed that their online shopping is, kind of exploding. American Eagle is a capital light based company, which is pretty rare in the retail space, meaning that they have more current assets than they do long-term assets, and that's where their focus is, and they also do not have a lot of debt that I'll get into in just a bit. So American Eagle has really been strategically focusing on Aerie and also the growth of e-commerce. Now, their app and also, just kind of the way that their business model works, it's a lot easier for them than a traditional retailer like, say, Macy's, to just kind of shift everything online and not have to really bog down their ROE or any other type of investment, because they're able to just, because they're capital light, they're able to just kind of move everything, buy anything that they need, based on demand, and they don't really have to go the whole brick and mortar route for the foreseeable future. And I think that they're going to become more and more of an online type of shopping environment than a brick and mortar, based on how the company is kind of transitioning things. They're introducing more things to do with renting clothes online, as certain other companies in Europe and a couple of companies here like Amazon, a couple of companies that go through Amazon are kind of switching to do, so that way people can kind of go in and out of fashion trends a lot quicker. So I definitely think that that is going to be a big revenue growth driver in the future. And also, the company has no debt. And that is one of the biggest things, in my opinion, is because when you have a company that is essentially going to get targeted by, say, an Amazon or any other large retailing space, they do not have the ability to, say, take a revenue hit for a couple of quarters and then everything falls apart. American Eagle is able to grow and has been growing at very fast rate in comparison to its peers without over leveraging itself, and that is a very rare thing you see in the retail space. So in comparison to growth, balance sheet, and also the direction that the company is going in, I think that American Eagle is one of the best retailers currently, and I think that they will be regardless of if the economy is doing well or if it's doing poorly. I think that people will still need to buy clothing. Obviously not as often if we're in a recession, but with no debt, I'm not worried about American Eagle ever going bankrupt, because they're generating a good amount of money in their free cash flow, and they do not have really any liabilities that will be eating into that, even if that number dips. So that was my last stock pick for the month of March. Let me know what you guys think about these stocks in the comment section down below, and let me know what you guys are buying for the month of March. Thank you guys for watching. Hope you guys like this video. Hopefully this video, being here on the whiteboard again, hopefully this audio comes out good, and hopefully the lighting isn't terrible. I know it's been a very long time since I've done a video here on the whiteboard, so let me know what you guys think. Do you guys like the whiteboard more, or do you want me to go back on the computer and just kind of show you my screen? Thank you guys again for watching, and I'll catch you guys in the next video. Peace.